So, if you've watched enough of my videos, you know that typically I like to script out the video, make sure I have all of the details and information in there so that you get a very clear picture of the message that I'm trying to send. But my original concept of this channel was that it'd be more like you and I sitting in my living room, having a conversation, and me providing information that helps you make fully informed decisions. That being said, for this video, I've decided I'm not going to script it out. In fact, I'm just going to have a conversation with you. And I hope you understand that I'm not doing this for clickbait. I'm not doing this to get new subscribers. The topic we're talking about, something very near and dear to you if you either own a condo and hope to one day be able to sell it, or if you're looking at a condo to be the best option for you in the purchase of your next home. So all of that being said, let's get down to the whole purpose we're here. In March of 2026, this year, March, Fannie Mae and Freddie Mac came to the conclusion that they needed to enforce the rules that are on hand. And let me go back. We all know if you live in California that there's an insurance crisis. Whether you're a homeowner or you're a condominium owner, single family home, condominium, doesn't matter. You've probably seen your insurance rates go up. And if you're a condo owner, you've probably seen your HOA fees go up dramatically as well. And all that ties to the insurance industry. And I'm not going to go into the reasons why I think that we could have years ago avoided this by handling the insurance and the insurance industry better by allowing the marketplace to handle the ups and downs of pricing. Well, I'm not going to go into that. So what I'll say is that all started a few years back. Farmers left the market. And when market, I'm talking about the HOA market. They left that market and they owned 70-80% of that business statewide. And in doing so, they left a huge void. And that void has been a nightmare for HOAs to mitigate. So what happened, HOAs get served with notice that Farmers is no longer in the HOA business for master policies, and boards say, hey, no big deal. Somebody else will want our business. But what do you do when you knock on the door and no one answers? And that's essentially the case with the insurance and HOAs. HOAs started knocking and nobody wanted to quote. They didn't. The risk of loss, catastrophic loss, just became too much to bear given the restrictions on pricing that these insurers were dealing with. And they finally said, you know, we're not going to take on the liability. The return on investment just doesn't make sense. So HOAs cobbled together different strategies. Some bought a multitude of smaller policies and layered those policies one on top of the other in order to create a scenario where they could have enough insurance. Others raise the deductibles exceptionally high so that they could also offer insurance. And for the most part, dues went up, but life went on. You could still sell your condo because your HOA was insured. Third part of that scenario is that some underinsured. Some use a number of half of what it would cost to rebuild. Some use a number closer to 80%. And again, life went on. You could sell your condo, you could buy your condo, and life was good. Well, now let's get back to that letter that came from Fannie Mae in 2026, March. And here's what happened. They said, your HOA master policy must cover full replacement value of the common area items, the residential units, minus the roofing. Strike one. If you're in the 80% range or the 50% range of replacement value, you don't meet that standard. And now you're unwarrantyable. What's that mean? It means Fannie and Freddie have decided they don't want to take those loans. So, another challenge. What about those HOAs that raise the deductible so high so they could offer an affordable policy? Well, Fannie and Freddie have come back and said, here you are. That's not okay. We're going to limit you to $50,000 per unit for deductible. Where's that money come from? Well, it comes from the homeowner, the individual condo owner, and the individual condo owner most likely was told in the documents and in every conversation they had with the management team for the HOA, you should include loss assessment of $50,000 in your HO6 policy. They didn't do it. You see the problem. So those big deductibles also, if they're above 50,000 per unit, you can't sell your condo. HOAs are going to have to revisit that. So now what? Well, some HOAs are going to be able to find they're going to be able to find full coverage. Some HOAs are going to be able to lower their deductibles. But here's the other challenge. All that comes with a cost. And now the state is telling us that we may not be able to raise dues more than 8% per year. Rent control on a HOA scale. Well, what if our costs go up more than 8%? So all of this, I'm telling you, just to make sure that you understand that if you own a condo right now would be a really, really good time for you to make sure that you understand exactly what type of policy your HOA has, what the deductible is, how does it line up with the guidelines that Fannie and Freddie expect. And this is important because most loans are sold on the secondary market within a year or two of being originated, so that the lenders can get their money back and and cycle that money back through again. And it repeats over and over and over again. Now what? If Fannie and Freddie are buying, let's say 75% of the loans, I think that number may be higher, and they're not willing to accept the liability of a non-conforming loan, you don't fit in that little neat little box that they want you to fit in. Here's your challenge. Your options are going to be more difficult and more expensive. So maybe you do a hard money loan, get someone to loan you the money and you pay them. Well, they get more interest for that higher risk. Maybe you find a portfolio lender. That means they're not planning on selling it anyway. They want to hold it, collect the money, monthly payment. Or maybe as a seller, you end up having to carry the paper yourself in order to make it all work out. Either way, it's not good news for the buyers. Certainly not good news for the sellers. And now's the time to make sure that your boards, if you're on the HOA board right now, you need to understand this issue is no longer about budgeting. It's no longer about making the numbers work. It's about the saleability and marketability of the homes, and that touches every single homeowner, every member of your association. This is something you're going to have to pay attention to. Buyers and sellers, same. So that's it. We had a little conversation. And what I'm going to invite you to do, if you would be so kind, is take a moment to like, subscribe, and ring the bell so that you always know when I'm ready to have another one of these little chats. And I do so every week. We talk about the greater San Fernando Valley lifestyle, Simi Valley, all the surrounding communities. We talk about things that are important to homeowners and hopeful homeowners, so that buyers and sellers can make informed decisions. That's what we do here. So I'm going to sign off by saying, if you like us, remember this. I'm Frank Spencer, Mr. Chatsworth, and until next time, I'll see you around the neighborhood.